Not one of our presidential candidates is proposing detailed, workable solutions for our economic problems. Hello, my name is Edward Sonino. You would think and expect that after going through a brutal multi-year recession with high unemployment, and with the real unemployment rate still high at around 8%, the 2016 presidential candidates would be offering solutions for preventing recessions and high unemployment in the future. But they are not. They are not even addressing the problem of recessions and high unemployment, arguably our biggest problem. The reason is that they have no idea which policies would be capable of preventing long recessions and high unemployment. Or they may mistakenly think that recurring recessions and high unemployment are inevitable and cannot be avoided. In either case, the essential point is the following. How can a candidate for the presidency of the United States be truly qualified to be president without addressing the problem of recurring recessions and high unemployment, and without offering a solution? Why is the press not demanding that the candidates address the problem of recurring recessions and high unemployment and offer solutions? Why are citizens not doing the same? At televised town halls and debates, how is it that no one is raising this crucially important issue? Though not generally understood, there is an economic policy which, if implemented, would prevent recessions and high unemployment from ever happening again. That policy consists of having QE finance tax rebates as the standard stimulus tool, as I explain in my book, The Solution, which you can read in its abridged version on my website, edwardsonino.com. Briefly, recessions are always caused by insufficient consumption, that is, by insufficient consumer spending. So, the solution lies in finding the best way to quickly boost consumer demand whenever it falls off and leads to rising unemployment. Tax rebates are obviously the way to instantly raise personal income and consequently consumer spending, thereby nipping recessions in the bud. And when tax rebates are financed by the Federal Reserve through QE, which is short for quantitative easing, such rebates do not raise real government debt at all. Preventing recessions has the added benefit of actually reducing government debt, since recessions lead to decreased tax revenues and increased spending on unemployment and welfare. How would QE finance tax rebates as the standard stimulus tool work? Whenever the real unemployment rate, which includes discouraged workers no longer seeking employment and part-time workers seeking full-time jobs, whenever that rate rises above 5%, the President, together with the Federal Reserve and the Congress, would determine how big a tax rebate is required to quickly get the real unemployment rate back down to 4%, the rate equivalent to full employment. For perspective, had the largely ineffective and unfair 2009 $800 billion Obama stimulus program not been targeted to help only citizens who did not need financial assistance, such as new car buyers, the Cash for Clunkers program, new home buyers, certain infrastructure companies, and certain state and local government employees, but had consisted instead exclusively of a tax rebate, each and every taxpayer would have received a $5,000 check from the IRS. A family of two taxpayers would have received two checks totaling $10,000. Clearly, such a tax rebate would have immediately ended the recession by quickly increasing personal income and consumer spending, and it would also have nipped the housing crisis in the bud, as families in financial difficulty would have suddenly had the means to keep current on their mortgages. So, there would not have been a bank crisis. With the tax rebates being financed by the Federal Reserve through QE, that is short for quantitative easing, as I said, and which means the Fed buying the newly issued Treasury bonds used to finance the tax rebates and keeping those bonds through maturity, the government's real debt does not increase by 1 penny, as I explain in my book and on my website. Today, with the real unemployment rate around 7% and 8%, we would need a $2,000 tax rebate financed by QE in order to quickly reach full employment. If a $2,000 rebate turns out to be insufficient to reach full employment in less than a year, then another rebate would be required. Importantly, since tax rebates are fair, with each and every taxpayer receiving the exact same check, no one would possibly could possibly complain if a second round of tax rebates were done. Without exception, all taxpayers benefit equally. There is no discrimination, as there is instead in traditional targeted stimulus programs such as the 2009 Obama stimulus. And so long as QE finance tax rebates are properly calibrated, that is, they do not cause excess aggregate demand, the situation where there is too much money chasing too few goods, they are not inflationary. It is very important to understand that QE is not inherently inflationary, contrary to the belief of many economists. In fact, we have had over $3 trillion of QE over the past few years with no increase in inflation whatsoever. Indeed, that QE has been concurrent with historically low levels of inflation. Why? Very simply, that $3 trillion of QE did not cause excess aggregate demand. As for why that $3 trillion of QE did not lead to a quick economic recovery and low real unemployment, the reason is that it was not used for tax rebates, which would have substantially raised personal incomes and led to big increases in consumer spending. Rather, that $3 trillion of QE was used to finance budget deficits and bail out the banks. For a quick economic recovery, we needed an additional, separate QE for the exclusive purpose of financing a tax rebate, thereby raising personal income and consumer spending. Another important benefit from having QE finance tax rebates as the standard stimulus tool is that it would avoid having the Federal Reserve implement an ultra-low interest rate policy, such as the one we have had over the past few years. Such a policy is counterproductive and unfair. First, by penalizing savers who can't get a reasonable interest rate on their bank savings, CDs, or on treasury bonds. Second, by reducing interest income, a very important component of personal income and consequently consumer spending. And third, by inevitably causing dangerous speculative bubbles in real estate and high-risk junk bonds through ultra-low interest rates. If QE finance tax rebates are the solution, why haven't they already been proposed by many economists? Because the economics profession is often mistaken and does not always come up with solutions. Hard to believe? Where's the proof? Just think of how many conventional economic theories are clearly mistaken, having been flatly contradicted by the statistics of the past 45 years. Yet they are still held by the economics profession and the Federal Reserve, leading to severely misguided economic policy. Which conventional economic theories? 1. That budget deficits cause inflation. Even non-economists know that we have had enormous budget deficits over the past few years, yet inflation has been at historic lows. 2. That budget deficits cause interest rates to rise. Again, even non-economists know that we have had enormous budget deficits over the past few years, yet interest rates are at historic lows. 3. That budget deficits cause trade deficits. There is no statistical correlation. 4. That budget deficits drive up the dollar exchange rate and cause the dollar to be overvalued on a trade basis. There's no statistical correlation. 5. That trade deficits are the mirror image of budget deficits. Again, there's no statistical correlation. 6. That money supply growth is tightly correlated with the level of inflation. Again, there's no statistical correlation. 7. That a low unemployment rate is inflationary. Again, there's no statistical correlation. And, contrary to that theory, as many ordinary non-economist citizens will remember, we had high inflation simultaneous with high unemployment during the energy crisis stagflation years of the 1970s. 8. That strong economic growth is inflationary. There is no statistical correlation for that either. 9. That a weak dollar is necessarily inflationary and that we always need a strong dollar. Again, there's no statistical correlation. 10. That the United States depends on foreign capital to finance its budget deficits, such as from China and Japan. This mistaken theory persists even after we've seen the Federal Reserve completely finance our budget deficits of the past few years all by itself through QE. You only need to be a casual observer with common sense to realize that we do not need foreign capital to finance our budget deficits. How our economic policymakers can't see that is a mystery. Way back on May 3rd, 1985, the Wall Street Journal published my article titled No Addiction to Foreign Capital, which explained the fallacy of the conventional wisdom that the United States was dependent on foreign capital to finance its budget deficits. Paul Volcker, the then Fed chairman, responded to that article. He reversed his excessively tight monetary policy, which had been based on the belief that we needed foreign capital to finance our budget deficits and that we therefore needed to keep our interest rates very high in order to persuade foreigners to buy our treasury bonds. He eased monetary policy and lowered interest rates. That allowed the dollar exchange rate to drop from its vastly overvalued level, and our economy quickly recovered from the severe slowdown caused by the Fed's high interest rates and the overvalued dollar. Somehow, the economics profession has forgotten what it learned back in 1985 and still believes the United States depends on foreign capital to finance its budget deficits. Just as disconcerting, during the stagflation energy crisis years of the 1970s and early 1980s, the Federal Reserve and the economics profession did not understand the difference between cost-push and demand-pull inflation, which require a completely different economic policy response. In fact, they mistakenly treated the inflation caused by soaring oil prices as a demand-pull inflation instead of what it was, a cost-push inflation. The result was a misguided, highly restrictive monetary policy, which led to absurdly high interest rates. The Fed funds rate reached 20% and long-term U.S. Treasury bonds 16%, while inflation was under 10%. As a result of that tight monetary policy, we endured a totally avoidable deep recession. Furthermore, those high interest rates hindered the investment required to help solve the energy crisis. Oil prices eventually stabilized and fell to much lower levels thanks to increased energy efficiency and increased global production of oil, gas, coal, nuclear, and hydro. Now, a brief word about financial regulation. Dodd-Frank is better than nothing, but a much simpler, cheaper, and more effective system would be to have a policy whereby the Fed temporarily takes over and recapitalizes any failing bank in exchange for newly issued stock, as it did during the savings and loan crisis in the early 1990s, while replacing its management and clawing back all management salaries over $100,000 and all bonuses paid during the 10 years prior to failure. That would guarantee prudence in lending and investing by the banks, while the Fed would get back its investment by selling the bank stock it received at the appropriate time, often at a profit. Another necessary policy measure would be the requirement for all derivatives and all other securities held by banks to be marked to market daily. For derivatives not traded regularly, they should be marked down by 30% each year they are not traded. Americans should realize that we need a president who truly understands economics, who understands where the conventional economic wisdom is mistaken, and who can think outside the box. That is the precondition for a president coming up with the economic policy capable of preventing recessions and high unemployment in the future, and for increasing everyone's earnings and standard of living. It is also very important that everyone understand that the only way to really help low and middle income Americans is through sustained economic growth, avoiding recessions and high unemployment, not through government-mandated hikes in the minimum wage, which are actually counterproductive, leading to fewer jobs at the minimum wage level as employers logically seek to contain costs. It is only through sustained economic growth and low unemployment that wages rise naturally in a free market economy without a loss of jobs. As for complaints about income inequality, they are misguided. The free market, free enterprise system does not work if limits are imposed on profits which reward competence and optimally guide investment. However, eliminating tax shelters is the correct thing to do, both in terms of economic policy and tax fairness. The whole issue of income inequality has essentially risen due to recession, high unemployment, and subpar economic growth, which have negatively impacted the wages of low and middle income Americans. What we need is not socialism, but sustained economic growth, avoiding recessions and high unemployment. The problem is not capitalism, or low taxes on the rich, or income inequality. The problem is bad economic policy. The problem we have is misguided, outdated economic policies which have prevented our free enterprise system from working properly and from greatly lifting all boats. Very simply, what we need is to have QE finance tax rebates as the standard economic stimulus tool. It is crucially important for everyone to realize that the economic policies we have had for decades are deeply flawed. Those economic policies have not prevented recurrent long recessions and high unemployment. They have produced enormous government and private debt, and they have reduced the wages and living standards of low and middle income Americans. The economic policies we have had for decades are truly outdated, primitive, and ineffective. We have truly had caveman economics. For sustained economic prosperity, to prevent recessions and high unemployment, and to greatly reduce national indebtedness, and to increase the earnings of low and middle income Americans, we absolutely need to have QE finance tax rebates as the standard economic stimulus tool. Thanks for your attention.